Hi everyone, welcome to my YouTube channel. My name is Tabitha. If you're new to this channel, welcome and please subscribe for more videos. Today we are going to talk about depreciation. So how to calculate depreciation expense using declining method, declining balance method. So this method has many different names. It's also called double declining balance, and it's also called accelerated balance. So we are now set to talk about depreciation and how to calculate depreciation expenses using double declining balance. But before we go into calculating depreciation expenses, what is depreciation? Depreciation is a process of reducing book value of an asset, tangible asset, over the lifetime period. So if you buy an automobile, so how much does it depreciate every year? And that process is due because of wear and tears or use, or maybe even passing of time. If you have bought like a car model this year, and then in the next 3 years, it will not really value the same amount. So let's look at how to calculate the depreciation expense using declining method. So declining method, balance method, is also called double declining balance, and it's also called accelerated method. So the reason why they call it like that is because we calculate more of depreciation expense in the earlier years and less of the depreciation expense in the later years. So the one that you calculate this year will be different from one that you will calculate in your 5th year or maybe your 3rd year of having that property or automobile or even a computer. So has you had take longer time using that tangible asset, it depreciate less as it goes back, because even like its value continue to reduce too. So let's see, how do you calculate it using an example. So this depreciation method called declining balance is calculated on undepreciated cost, which means you use net book value of that current or of that tangible asset to calculate depreciation expense. So like for example, in 2004, you have a net book value of $1,000. So you will use that $1,000 times the depreciation rate to find your depreciation expense of that year. So, and then again, we use this type of method on different classes of assets. We can also use it for, and different classes of asset has different rate of depreciation. So we have a lot of characteristics of this declining balance as a method of calculating depreciation expense. But let's look at the example so we can get a clear picture of how it is done. So next time, if you have a car or house that you really want to calculate depreciation, you will really know how to calculate it. So let's look at it. So, but before you calculate the depreciation expense, you need to know the component of calculating depreciation expense, and the main one is net book value. How do you find net book value? And then later on, you will look at the rate that you will depreciate it. So here we have net book value, which is the original cost minus accumulated depreciation. So original cost is the cost of buying that asset plus all the expenses that you put in to prepare that asset. As let's say, for example, you buy a computer and you buy maybe a hard copy that you put into your computer. So the cost of hard copy that you install in your computer is also part of the original cost of the computer. And then you get your accumulated depreciation. So once you subtract accumulated depreciation from your original cost, you will get the net book value. Yeah. So let's look at the example. So we look at the example. A company uses the declining balance method of depreciation for each automobile at a rate of 30%. So this 30% is the rate of depreciation of that tangible asset. As of December 31st, 2004 year end, the original cost. So now when you go back to your book, you look at where is the original cost is recorded and what was the accumulated depreciation. So the original cost was 100,000 and the accumulated depreciation of that automobile was 25,000. That was the balance in the book. So you will be asked how to calculate depreciation expenses for 2005 and 2006. So before you go there and to really make it clear so you can see how we calculate it without no confusion, for me, I will do a table so you can see everything clear. So let's look at the table. So this is the table. So in this table, you have the years. So the years that you will be holding that asset. So in that, you have the original cost and you have depreciation expense and you have accumulative depreciation and you have the book value. So on December 2004, so what was on your book? So on your book, you had 100,000 as the original cost of that asset, which is automobile. Depreciation expenses that you had accumulated to till that time was 25,000. So here you can calculate the book value. And as I said before, it is the original cost minus accumulated depreciation. So you get the 100,000 here, you bring it here, minus 25,000. 25,000 is the accumulated depreciation. So if you find the difference of these two, you will get 75,000, which is our net book value. So by that time, in 2004, December, that automobile valued 75,000. It was no longer 100,000. Yes, it has gone down to 75,000 because it had depreciated by 25,000. So the current value is 75,000. So if you had to sell it that year, you will only receive 75,000. But you were not selling it, so we had to calculate the depreciation in the following years. So 2005, you come down and you record original cost is always the same in this kind of method is 100,000. But now you need to calculate the net book value depreciation expenses in 2005. So you will use the net book value from the previous year, which is 75,000, bring it down here, and then times the rate, which is 30%. So then you will get the depreciation expense in 2005, which is 22,500. So when you keep that automobile for the next year, which is 2005, it will depreciate with 22,500. And how much have you accumulated in depreciation since you bought this, or maybe since the last time you record your books? So here, accumulated depreciation for 2005 would be 25,000, which is from last year, plus this year depreciation, which is 22,500, which will give you 47,500. So accumulated depreciation is always the opening balance from last year book plus the current year depreciation expense. So the expenses you already calculated plus the last year, which is 25. So you get the total of 47,500. So now we need to know again, in 2007, how much does our automobile value? So our net book value by the end of 2005. So we bought it at 100,000, and then it has accumulated until this, it has depreciated until this point by 47,500. So if you find the difference, you will have the net book value of 52,500. So if you had to sell it this year, 2005, you will get 52,500 from someone who is willing to buy your automobile. So this is the thing that you will get, the value that you will get for selling that automobile. But you're not selling it. We are going back to 2006. So in 2006, we also need to understand how much did this automobile depreciate. So we all start again with the original cost, which is 100,000. And then we calculate depreciation expense. So depreciation expense, you have to get the net book value from the previous year or what is currently on the books, which is 52,500. So get the 52,500, bring it down. Time is the rate, which is 30%, and you get the depreciation of 15,750. So this year, 2006, because you kept that automobile, it is going to depreciate by 15,750. So now let's calculate the total accumulated depreciation until this point in 2006. So how much has this automobile depreciated? So you take 47,500 from last year, which is here, bring it down, plus the depreciation expense for this year, which is 15,750. When you add them up, you get 63,250. Now, how much does your automobile have? How much does it value at this point? So you will go back to the cost that you bought it for, which is 100,000. You bring it here minus the total accumulated depreciation, which is 63,250. When you subtract, you get 36,750. So if you had to sell, this automobile this year, you will only receive 36,750. Sometimes you can even sell it less than that. Maybe no one is willing to buy your automobile and they're offering you 225,000 instead of 36,750. So that is how you calculate depreciation expense. So depreciation expense, it depends with declining method, it depends on the net book value and the rate of depreciation that asset is depreciating for. And then how to calculate the net book value. The net book value is that final value at the end of each year. What does your asset value by the end of that year? How does, if you had to sell it, how much will you receive? So basically, depreciation expenses using declining method is like inverse. So you see, it goes by from the highest to the lowest as it declines. So it means like when you just bought your automobiles, you will record higher depreciation expense in the early years and lower depreciation expense in the later year. So as you go down, the depreciation expenses reduce. And this is because this depreciation expenses using declining method is calculated on undepreciated cost, which is the net book value after every year. So this is the end of the video. Thank you for watching, and I will see you next time. Don't forget to subscribe for more videos, and bye.